Hi, everyone. Welcome to Zillow Rentals Quarterly Insights Webinar. I'm Brian Miller, Director of Partner Experience and Engagement, and I have the honor of serving as your host for today's program. This is our third Insights webinar of the year with our resident experts, Zillow's Chief Economist, Skylar Olsen, and Senior Population Scientist, Manny Garcia. These webinars are designed to provide you with the latest trends, market analysis, and predictions to help inform your business decisions. Whether you're a property marketer, owner, or simply just interested in the rental market, this webinar is packed with information that will empower you and help you stay ahead of the curve. For those of you who were able to attend our webinar in June, Skylar discussed why rentals are poised for more growth, the impact of inflation, how wages and labor participation put pressure on the housing market, and so much more. We also heard from Manny Garcia, who presented key findings from the 2023 Zillow Housing Aspirations Report, detailing how renters and buyers feel about the construction of multifamily homes in their neighborhoods. Today, you'll again first hear from Skylar, who is going to present the very latest from the rentals market, including diving into some specific regional markets. Skylar is Zillow's chief economist. She was a foundational member of the Zillow Economic Research Department, where she leads a team of economists and analysts who provide unbiased data about the housing market to inform policymakers, journalists, academics, and consumers. Dr. Olsen is often quoted in media outlets around the country. We are so fortunate to have her here to unlock economic data for our partners. It's all yours, Skylar.
All right, thank you so much, Brian. Okay, it's September and it's time again to jump into rental markets and the economic data that captures it. Now, as you may be familiar, Zillow has a rich and vibrant rental market. Now, when we build markets like this, whether it's the for sale market or Zillow's rental marketplace, new construction data, and its growing mortgage market as Zillow operates and expands Zillow Home Loans, we build a pretty rich and robust, and honestly, for a scientist like me, for an economist, an incredibly sexy data set to help figure out what's happening, right? So Zillow builds this big data set ultimately to support customers and build our products that you interact with and those customers interact with every day. But there are economists and scientists at Zillow whose primary job, right, is to figure out what is happening on behalf of customers and housing professionals, as well as Zillow leaders. But no matter who you are, I like to explain that data, as cold as it may seem, as wonky, as analytical as it may seem, still helps us as humans do these three primary things, okay? First and foremost, do you ever have the experience that you wish someone had taped your life, right? Or there was a recording of that last conversation you had, or whether or not you actually did, in fact, do or clean the dishes, right? Well, data captures the past. When we watch the transactions or the listings that happen, the leases that follow, right? That can, when we analyze that, it validates our experience. It's kind of like someone had recorded it for you. So we can be on the same page when we talk about what's happening. Okay, now our experience changes and the data changes to capture that. So the data can help us reset our expectations. So we're going to do that today as well. And finally, and this is kind of the secret sauce of The Economist in particular, is that data can help us anticipate and prepare for what's next if we apply, a smart and thoughtful lens, connecting all the dots and the pieces of those different metrics together. Okay, and then what I've just described, right, is a process where ultimately we're going to make it make sense. Okay, that's my job and my role as an economist at Zillow and the other economists at Zillow to harvest that data set and put it to work for you. So let's do that. And let's do that first with, honestly, my favorite metric that comes out of the rental market that we operate at Zillow. Let's spend a little bit of time talking about this because this is a really important signal that can capture competition in this market. right, of renters for available leases and available inventory. But when we watch it change in that same way, it's capturing new supply coming on the market or new demand pressure or falling demand pressure, right? So there's a lot that's behind prices, right? Okay, so this is Zillow Observed Rental Index. What this is trying to capture, and we're ultimately, you can design a rental index any which way, right? But we're going to design it to try and do the following thing, okay? We want it to capture market rate asking rent. So the concessions are not built in here, right? And you, as you operate your business, might understand how asking rent differs, right, from some more of the concessions that you might operate as rental markets become a bit softer, okay? So this is capturing that market rate asking rent, the data that I contribute to the information that's in here. I'm going to kind of adjust it so that this reflects the whole rental market stock. So the single family homes that are typically rented, but the bigger part, the apartments, the small garden style buildings, but it will reflect the whole rental stock, not just the set of listings that become available in any one month, which jumps around a bit more. So in that way, it's going to help us track things over time. Okay, now I have two graphs on here, or rather two lines on this slide. Both of them are Zori, both of them are Zillow's Observed Rent Index. One of them, though, I've taken the seasonality out of it. In our business, when you're operating, when you're thinking about when do I market my available listings, or if you're, planning property management, or if you're a building owner, right, and you're thinking about, how do I analyze the data that I see, or how do I think about it? Seasonality is a big part of this. So we're in September now. It's mid-September, which means the most recent data that dropped was right at the end of August. Okay, so I'm starting to see August come online, and you can see here in this image that at August time, this line is flattening out, right? Seasonal Zori, when we capture this, is we've kind of gone past the hotter summer months when everyone's moving. And now we're at the stage where everyone's in place, hopefully, for school, right? Because a lot of us, whether we ourselves are in school, or if you're like me and you've got tiny humans at home, your rhythm kind of comes a lot from what's coming in August and September, right? So here we are flattening out. This is the time to take a breath. But there's this macro trend that we're also trying to watch. Like, what is the pressure on rent? How's it going to go into the future? How does it compare in the past? And then it's actually really helpful to look at the seasonally adjusted line. You can see here how they're related, right? But we're going to tease the different messages that we can take. Now, before I move on, I think this is the best slide to just take a hot second and pause. And look at this thing. And I want you to look how rent grew before the pandemic, what that pace was, kind of how, it might have felt, if you operated rental markets back then, like put your hat back and just try to remember, you might have felt like it was pretty exciting. It was an exciting business. You're operating someone's shelter right in their space. But look at the time period after the pandemic. Okay. Exciting might be one word, uncertain might be another. Volatile, is certainly a word that pops up if you're a data person and you're thinking about the change here. If from a perspective of a renter, this was a hit to affordability that happened in a short period of time. From 2015 to 2020, so that 5-year period, you saw a typical rent in the nation grow by about $300, right? In the less than 3 years that we've seen the pandemic occur, you see more than $400 increase, right? So that's a sudden jump. And you can see that it happened in a dramatic kind of way. So we can kind of tease that out and tell that story. Honestly, it's a frozen market during eviction moratoriums, right? And in those early days of the pandemic. In some places, rent fell during this time, right? And then you've got this incredible rent boom as support takes place. You've got a lot of economic stimulus. We're no longer paying for student loans. We're moving because of remote work. That's putting a lot of pressure on rental markets because turns out people can move a lot faster than you can build buildings. And we certainly can't pick up a building and move that over, right? So we've got this explosion on rent. And then if we look at that smooth and seasonally adjusted line, we can see that that's coming out and flattening, right? So let's tell that story. I want to make a point real quick. I just talked nationally, over the course of the pandemic, you're looking at over $400 for a typical rent increase. Now that's going to mean very different things depending on where you are in the nation. So we're going to also be able to get local. This is the other exciting thing about operating a rental market at Zillow, is that we can analyze, data more and more locally to figure out what's happening in different places. And that's critical in housing, of course, because location is everything. You can see the huge range in what a typical market rate asking rent would be, right? And that incredible range. But when we talk about the changes that have occurred, we do share so much, okay? Now, the changes that have occurred. Let's start thinking about the pressure on rent. When during the year does rent grow the fastest? So here I've highlighted and pulled forward the seasonality is still in here, okay? So this is Zori at a national level, but you can see the seasonality. What you should or could be noticing is that you really experience the kind of the most pressure on rent towards the end of the last year of school year, right? And then everyone's thinking, where am I going to be for this next one? As a bulk of people kind of follow the rhythms of school or academia, right? And then that starts to calm down and we enter into a slower period during holiday season, right? Now, what you could notice is that we had a huge pandemic shock, and that was separated by that vertical dotted line there. February 2020 is, a time I think that I often kind of put that dotted line to kind of think of a before and after. Look at that shock in the pandemic. And when I look at a shock, an economic shock, I think it's really nice to get another metaphor in your brain. Think about dropping a marble, right? And how that might bounce and how we might see an explosion the first year we just discussed why, right? People get the stimulus packages and they're moving for remote work. And you see that incredible pressure as people move out. And markets kind of, then adjust. It takes a while for it to cool down, but yet we still have this seasonality each year during winter where it cools off again and then speeds back up. Notice, though, that the seasonality was pushed out during the pandemic. We were late to get things done because our rhythms were disrupted by COVID-19 global pandemic, of course, right? And then look at more to the now. Maybe we're returning a bit more to traditional seasonality, but at that same token, we are slowing down more than we did pre-pandemic. Okay, so now I just switched us from seasonality is in here, the ebb and flow of our actual experience when we operate these businesses. So there's a timing here, right? When should we go advertise? Probably right. But we better be ready, right? Leading into that moment, okay? And then when we think about, why we might, we're going to go through a couple of reasons to deseasonalize here, but the one that first jumps out at you, pops out, is like, what is our trend, right? Where are we going from here? How much cooler will this feel relative to last year, relative to maybe a normal market pre-pandemic? Okay, so let's think about that. Let's take the seasonality out of it, okay, and look at relative to what period of time, how are we feeling? Okay, now what you'll notice is that, that raw seasonal one, we're still feeling it, but we're cooling down a little bit faster than one normally would at this time. And that's related to the idea that the whole market is probably cooling down, and we'll talk about why. But this is what we're feeling when we think about rising vacancy rates, right? Or a little bit harder to find that renter, right? For your unit, I mean. So we're seeing Zori that's deseasonalized at a national level, flatline, right? It's flat right now. Whereas something that was normal, if you look back in the past, you see that dotted line, I would consistently grow on average every year. So flat is actually kind of like falling in the sense of very soft for this time. Okay, so there's another reason besides where we're going, and I will explain why we're getting soft in a second. But I think a much more imminent reason to look at a deseasonalized metric for Zori is it helps us kind of compare regions. Now, some regions are going to have some different seasonality. Columbus, Ohio, for example, on this image, look, it's a massive university town. Okay, you've got Ohio State University, so it might be a little bit more seasonal, right, in this kind of metropolitan area. By the way, this graph here, these are rents in the whole metro, so usually multiple counties. That makes where one might live and go to work, right, across the space. So we're looking at the rent trends here. This is Zori itself, not the month over month, which we were just looking at, but now just it itself. Okay, so you can see that the pandemic kind of speeding up. Now, when we look at this, seasonality might be different from place to place, but I think most of the time we're thinking about, what markets are getting hotter versus others. And we want to deseasonalize to make it easier. We're thinking about where should we, maybe go grab more contracts or more buildings, et cetera, et cetera. Okay. So when I look at this graph, some things that are going to jump out at me are things like Columbus and Cincinnati, Ohio. You've got really similar dynamics moving forward through time, similar throughout the course of the pandemic. If anything, the rent gap between Columbus and Cincinnati might even have narrowed over the course of the pandemic as Cincinnati has kind of grown a little bit faster. Now, Cleveland, Ohio, that's a bit of a different story. Slower growth during the pandemic, though still experienced a pandemic boom, and also slower growth beforehand, right? So this is indicative of more a longer run growth pattern that I might want to consider across these three metros. Let's do another one. Let's go a little bit more west and look at more of our central markets. Across here, I couldn't stop adding some because it was kind of fun to watch them change locations. What jumps out at me immediately on this graph is thinking about an area like St. Louis, right? Generally, when I see rent growth, again, if it's faster than say, or if rent growth is stronger, that means demand is generally growing faster than supply. So where are we moving forward? You can see a changing of places between Des Moines and St. Louis in terms of how expensive rent was. That was happening in the past. You can see that before the pandemic. But boy, it happened right away and accelerated over the course of that pandemic. I can see areas like Oklahoma City are flattening out a little bit faster. Well, there's still a little bit of juice, say, in Kansas City and St. Louis. And then I might have an area, say, like Wichita, Kansas, that already started much more affordable, did experience a pandemic boost, and is much softer now as well. Slower growth then, a bit slower growth now. These are really valuable tools when I get more and more local. Let's show you the drama in Texas. I think a lot of us have heard headlines about Austin. This kind of incredible rent boom, there is a bit of a pullback here. To bring it into the modern vernacular, an economic clapback. Okay, so the rent is falling much more aggressively in a place like Austin, but even Dallas grew so much over the course of the pandemic. And so you can see seasonally adjusted rent in particular falling in the Dallas metro. Now let's take Dallas and go even more local. I chose Dallas here because it is a very large metro. There are good sample sizes down in local areas. Now we're looking at the city. And now what we're doing with this kind of data is we're thinking similarly what markets, are moving more than others, but now we're bringing it down to a city level. Okay, so this is a lot about people moving out to the burbs when they have kids or maybe when they retire, wanting to come back in again. Are downtowns, people coming back to downtowns? How are those locations going? You're also thinking to yourself, where were the deliveries, right? In terms of new apartments, that's, that new supply competing with your space. So if I see rent suddenly get soft, it might not be because this neighborhood is struggling. It might be because there are new opportunities, right? Okay, so look at this story. Here we're looking at month over month change in rent during 1 month. We're looking at Augusts, always looking at an August or a change from July to August. And let's look at these snapshots through time. I love doing this over the course of the pandemic. You saw the pandemic shock, so it's fascinating for a data scientist to watch. You can look at 2020. Here you see rent falling in a lot of the cities across Dallas, metropolitan area. But you do still see continued rent growth in others, right? So it's a bit of a spread. Okay, but now 2021, we are further into this pandemic shock. We have passed the first year mark for sure, and we're a few months in from that. We have our stimulus checks in hand. We see that incredible pressure start hitting the rental market. This is month over month growth. And some of these cities are going all the way up to 2 and 3% rent growth during this time. You can see that spread. You can see the pressure was more on the northern cities in the Dallas area as well, actually, maybe counterintuitively, more towards the main core cities in the metro. Then you go to 2022, and here we start seeing our shock, our pullback. So that market clapback experience during this time, we're starting to see mortgage rates go up in the for sale market. And a lot of people are going a bit on hold, right? Also, what's happening during this time, over 2020 and 2021, you're getting the buildup in permits. So we might be seeing more apartment deliveries coming on in certain cities, maybe in particular those areas where I have really negative rent growth and a month-over-month pressure. And then that brings me to today. I'm reflecting on today that there is a lot of difference and a huge range across the Dallas metropolitan area. But I do see that kind of, there's not as much of a flow up or down. It's kind of, there's a huge range, but it's more sprinkled kind of about with what's going on from place to place. In other words, that pandemic remote work expand out and are we contracting back? I think that dynamic is a little bit spread across. We're not seeing that rush back or that clap back too much towards the downtowns per se yet. So that's how I might go through that data and analyze it. I mentioned at the beginning, though, that a big reason that we want to look at the deseasonalized metric is to figure out where we're going. And we're at a time in the net global economics. So I was about to say just US economics, but I think it's really fair to say global economics. We're at a time where we're going is probably like the hard part. We can compare probably place to place. Sample sizes might be a little, well, they're increasing, right, as we get all these kind of more apartments online. So comparing place to place, there's more volatility because all this kind of macro volatility is bigger. But that's not as challenged as saying, where are we going to go? Now, when I start talking about where we're going to go, we're going to, deseasonalize things so we get down to the trend. So that's where we're back to this graph that we saw before. I mentioned that where we are now is softer than pre-pandemic growth. So we're going to explain that one. And then we're going to try and think about where we're going. And we have to set it in the greater uncertain macro kind of picture because that's the world we live in. But we're going to take it from this world that might feel like chaos, all these headlines, about what's happening. And we're going to look at the data. So that's that validating our experience, but also resetting our expectations, like what's real. And we're going to do the Economist work of then, figuring out where we're going. Okay, so let's do it. One, let's validate. So the rent is slower than it was pre-pandemic. Do we see that validated, in other metrics that also capture competition between listings? Yeah, I mean, we're starting to see national vacancy rates increase. They're still relatively low. We've had, and this is going to reinforce the idea here that we do have a lot of new product coming online. There's a lot of under construction still in that pipeline. And so we might continue to see, vacancy rates rise. But before I move on, I do want to point out that we had pre-pandemic seen this number continue to fall as it was hard to keep up and build with the households, right? So we had been consistently underbuilding, but this increase in vacancy rates does kind of match a bit with that softer rate experience, right? Now, it matters a lot why these things are happening. So is rent falling and vacancy rates rising because the renter, the households, are in trouble, right? And I think when we look at the macro picture, and possibly you may even get this intuition when you hear headlines, is that that's not the picture. There are renters that are in trouble who are experiencing rent affordability challenges, particularly as you go kind of lower income, right? There are definitely households struggling. That is not what I'm saying. What I'm saying is our job market strong enough that you could find more job market opportunities now than maybe times in the past, right? So what is the pressure on, like, how well can you go out and get employment should you want it? Okay. And what we're looking at here is a labor gap. Okay. So this is the job openings in blue and then the number of unemployed in black or dark maybe. So what you're looking at here is there's still a big gap. I mean, there's still many more job openings than those that are out there looking for them. So, I know from an individual level, it's like, yes, but what's job and what fits me and can it pay? But as a macro level, relative to other times, it is easier to get a job than at other times. Unemployment rate is at 3.5%. That is lifted only from 3.4. That's as low as it kind of goes. So we're still around full employment. Job growth is slowing down, but still steady. Now, that in itself is an economic surprise for a lot of people when we track the macro picture. But let's just stay with the idea of what it means now is that the renter is still, most on average, a renter is able to get the employment to sustain, economic vitality, sustain themselves. Okay. Now, the other thing that's happening, and you may have heard headlines about it because it has been an absolutely big deal, and it drives a lot of what I'm thinking, is that general inflation, rent aside, has been a huge problem for our economy over the course of the pandemic, let's say, recovery from all the stimulus packages and also Fed money themselves to lower interest rates. A lot of printing money kind of behavior happened over the course of the pandemic. So that put a lot of pressure on prices. Check this out. Prices were growing way faster than incomes for a hot second. And yes, early in the pandemic, we were saving because we weren't doing anything, right? But then once we started reopening, the rent was growing, right? Our savings rate really fell because most of us out there in the world operate a bit paycheck to paycheck, right? So today, check this out, inflation has been coming down and wages are coming down much more slowly. That gives you a little bit more time to get your feet under you. We're starting to see savings rates increase, right? So maybe the renter is actually stabilizing a bit. So there are renters who are absolutely still, pre-pandemic, we were talking about a housing affordability challenge, okay? But we're just thinking about how things, have changed over time and what are all the other macro things that are happening. The renter is still stable. That's not what's happening. That's not why rent is falling, okay? This is why rent is falling. The purple guy made headlines for a while, right? The purple guy is the number of 5+ units were under construction. So like units in apartment buildings, okay? Well, that made headlines early. That was a big ticket item, but it takes a long time to complete these buildings. Okay, so we start early. You see the permits rise early on in the pandemic. I mean, there was a shocker, right? You'll see this in a sec. But payments rise early, we hold your breath. But then permits went up like crazy. Apartment construction went up like crazy. Check out that blue line. Only more recently did those apartments actually get completed at a much faster clip or come on the market, right? At any one time. So that puts a lot of downward pressure on rent because you have this extra supply. I like to think about, I've never seen, the completes drop that quickly in 1 month, but, if supply is putting downward pressure, on rents and this many buildings, are being completed, might imagine that there's an incentive to maybe delay a bit for more coming down the pipe, right? But then I like to think, why were we building so much in the first place? We saw the time series on rent, so we saw the pandemic surge. Let's show it more across our different metropolitan areas so we can bring more of our audience in with us here and they can feel like they have the rental touch. So here we're looking at rent change from February 2020 to today, to August 2023. So we're looking at the course of the full pandemic. Here you're looking at the love that the U.S. gave, okay? And a lot of southern states, if you look down that side, not just Nashville, Tennessee, golly, Knoxville really exploded, okay? We also see a lot of movement down to Albuquerque, New Mexico, right? I've been telling people a lot, I haven't seen Albuquerque a lot in the headlines, but boy, I might want to go visit. I think Boise, yes, made headlines. We all saw that, as well as San Diego, and down south and more inland empires of California, right? Saw just that incredible rent pressure. Clearly, there are lots of areas, though, even if you were in some of these slower growth spaces, to renters that live in these spots, it would feel like a lot. To builders that operate in these spots, it would be a call, right, to build more. This is the magic of markets. This is really what gets economists going, right? Is that I have a pressure on price that impacts the customer, and the supplier will come and respond in response. Okay, but now let's bring to more recent time periods. So that was over the full course of the pandemic. That's, you're almost 3 years. And now we're going to bring it down into just the past year. I start to see negatives pop up. Where do I see the negatives pop up? In some ways, those same places that saw at least significant pressure, not the hottest necessarily. There are places where they're continuing to see population flows, right? So these are areas where, like Florida, right, continuing to see a lot of pressure. There are places in Florida continuing to see a lot of pressure in the for sale market as well. And you might think, what's going on with my joke? Honestly, I say this joke on stages. The world would make a lot more sense if it wasn't for Florida, right? Because you got this space that has become so unaffordable and yet continues to grow. So what gives? Well, when we think about flows down and why even now, if you continue to look, you got hot, LA, you got hotter San Diego's, right? Well, forget about that. I mean, the sun is attractive that way. But when you think about Florida and pulling down, you're also thinking about a lot of tax advantages during the course of retirement, right? Or other reasons to move to kind of more of those southern states. So people are flowing. Okay, but let's go to the more recently. More recently, remember, we were talking about rents slowing down. So here we're looking, this is all seasonally adjusted rents. So these are the ones that have that kind of where are we going kind of mentality. And it is month over month though. So it's just kind of 1 month point. This isn't a big, huge trend. This isn't a forecast, but we can look across this space and think about which places are currently, really currently, month over month. So from July to August, this past month over month change, where is that active pressure? I can see that, Austin is still experiencing more of that price clapback that we saw, in that time series relative to almost anywhere else, across the country. There are other places still consistently soft that way as well. Other Texas markets, your Boise's, right? Portland's, Phoenix, that's Las Vegas. And then there are other places where it's still a little soft and others where things are still going. So look at Connecticut, right? Areas outside, sort of commuter into New York City. People do it, right? In Stamford and Hartford and up through there. Okay, so we see a lot of these rental pressure, and it can give us a lot of different ideas about how to operate the business, where to advertise, where the pressure is, but that's great. We talked about where we're going. And again, it's just that, when I think about where we're going and what I get when I get with Zori is just where prices are going. And as an economist, if I'm going to think about what's ahead, I have to be able to see around a corner. Because what's going to change is not just the current momentum I'm on, right? There are other things that are happening all the time. We don't operate in a vacuum. So I got to put all the pieces together to try and think about what's ahead. Well, first, we talked about that construction boom, now seeing a lot of the apartment completes coming online. We talked about rent really softening. The magic of markets also works in this way too, where it starts slowing down the construction, apartment construction. So here you can see in gold that permits in 5+ unit buildings. So apartment permits. So how many apartment units were permitted? This is a annualized rate, right? So when you see this, that's the rate that would happen if you permitted that much every year. Okay, so you could see that come down a lot. And actually that started coming down when rent started being much less severe last year, right? So markets have already been adjusting to the slower rent pressure. So that is comforting to me that the world can make more sense. Okay, now I also want to show you the single family permits in this space because it's kind of on the flip side, right? The single family permits are, when you think of construction, new listings in the existing market have pulled back so much. You're seeing that boom in builders, not because interest rates are down or, there's this change in an affordability picture, but because sometimes that's the only option, right, for sale markets. Okay, we're also potentially seeing continued construction in single family rental spaces. We will re-release soon our view of single family versus apartments in our Zori, which is not yet available again as we reevaluate that metric. But what preliminary evidence does show that single family markets are growing a little bit faster in a similar way. Okay. Now, the other thing that we want to think about when we think what happens next is just to confirm, and I mentioned earlier when we saw the rental vacancy rates declining even before we hit the pandemic, that we have been underbuilding for a bit, and how we might even think about that when we think about the rental market and we think about, what it takes to build enough to keep up. I like to show this graph because it reflects that, yes, the boomer generation is big, right? And we hear about the millennial generation, but when we think about the prime ages for moving out, for going to build our careers, for getting our own apartments, moving out of our parents' homes, right? That happens at age 26 on average now. It takes us a little longer. It's harder to launch than it used to, right? And that means we've got a lot of people bearing down on those rental markets. But people talk about, that our birth rates are declining, right? But we also continue to accept people from outside. And when we accept people from outside, meaning from outside the US borders, from Europe and Asia, everywhere, right? We do tend to accept people that are at early stage career. So those are younger generations. I mean, there are plenty of people that will come and continue to need housing, right, in the future. Now, we do surveys, and you'll talk or see Manny in a second, and he'll dive into much more of this kind of insight, right? But when we think about the environment that we're in, right, and we think about, how many people might move, and, when we're, hopefully it's come across, right? It's not that renters don't want to, right? It's not that renters don't have a bit of economic stability behind them, right? The softness that we're experiencing in the business is that there is other supply. There are a lot of people potentially even, watching this video, right? In that sense. So we've got a lot of that demand moving forward. Now, not only that, but that demand is going to be blocked more than usual from moving forward into a for sale market. So median age of a first-time home buyer is 36, and millennials are starting to enter into their 40s, but they're going to hit an experience where it looks like this. Okay, now we talked about how rent grew over the course of the pandemic, but home prices grew a lot. More than that, interest rates, the mortgage payment is so sensitive to interest rates, and interest rates went from around 3% in the pandemic to now above 7%. Now, for interest rates to be above 7% does this to maybe your monthly payment. You see in gray at the bottom, estimates for property taxes and insurance. And then you can see at the top, your estimate for your monthly payment that is interest rate informed. Now, these aren't exactly apples to apples because I am actually comparing different rent or for sale stocks when I use these metrics. I am currently working on an analysis to do a better apples to apples job at thinking about what is that affordability difference. But if you just think about the rate of change of these two lines, it's stunning, right? And rent got more unaffordable, but to enter as a homeowner, to sustain home ownership, that monthly payment was all the more so. Okay, so not only do we have fairly economically strong renter base, I've got a strong renter base that's blocked from the for sale market for an economic decision basis, right? I will more likely choose to stay as a renter because it's more economically feasible to me. It's more likely to be affordable even on a monthly basis. I am setting aside the idea of wealth growth and other things, which is a big reason that some people move forward into homeownership, or even, rent stability. There's lots of reasons why people move into homeownership that has nothing to do with this graph, but this change does impact how we think about what's coming ahead, right? Now, when will this block go away? Well, mortgage rates could come down a bit, and I'm not going to be so crazy wonky with you. This is going to be my wonkiest slide. Actually, the next slide might be a little bit wonkier. But what this slide kind of shows us is how to think about mortgage rates coming down. So that blue guy, that's the mortgage rate for a prime borrower. And boy, it's high right now. And you saw on the last slide what that does to the mortgage payment. Okay, so this thing is up here. When will it come down? Mortgage rates, 10-year treasuries, financing for multifamily construction buildings, all of these is long-run debt. So when someone, on this side is loaning it to you, it's like a long run security, right? It's like a long run investment. All of these interest rates tend to move together. Here's the thing. Over the course of the pandemic, the 10-year treasury and the mortgage rate started moving apart. That's what's reflected in that gold line. That's a spread between mortgage rates and the 10-year. Both of them reflect long-run expectations, but the mortgage one reflects extra stress in the mortgage market. Where's that extra stress? Well, over the course, that extra stress over the course of the pandemic, the Fed, and even pre-pandemic actually, the Fed plays a huge role in the mortgage market, that secondary mortgage market. So yeah, the lender gives you a loan, but they have to turn around and sell the servicing rights and actually all those mortgage-backed securities over here. Okay, but the Fed buys a bunch of MBS. Check out that blackish, dark navy line. Okay, so the Fed participates in the mortgage market, and they did it to support us over the course of the pandemic. What you harder to see here, because I'm also showing you other assets held by the Fed. And the reason why I do that is because this is actually our little liquidity crisis. And it helps put it in perspective when you think about what the pandemic actually was. So this is that banking crisis that you might have heard the headlines about. But over the course of the pandemic, boy, that's the real story. This is a downward curve right now. In other words, the Fed is not buying in the mortgage market. If you got a big institutional buyer like the Fed, who's in there just to buy at a certain price, that's a huge stabilizer in the market. So while the Fed is not participating, there's a huge spread between these things. When will the Fed stop not participating in this market is when they no longer have to continue unwinding this balance sheet in order to pull pressure down off of general inflation. So how are we doing on general inflation becomes the next question. And when we think about inflation, these are the headlines. This is kind of how the headlines sound. So the top, this is CPI in gold. CPI is the consumer price index. It's that fixed basket. It's the headline maker. This, at its most, this is year over year in this price basket. And you heard 8% price growth. And then you think like year over year gain. Who got an 8% raise? That's crazy. And that was what a lot of us experienced. That was very painful. But we have different measures of inflation that get more to core. So we drop out things like food and energy that change a lot. And then we also switched to the ability to substitute away from price spikes. Like if the price of pork is so high, I'm not going to buy it. I'm going to buy chicken instead. Okay. So those are things like the core PCE and the mean PCE. They never got as scary as the headline maker, right? But they're still way above target. So the Fed's trying to bring those guys down. And you can see it's hard to bring it down. This is year over year. Year over year just means what it was relative to last year. If I want to look at current pace and current pressure, like I've already showed you before, when we were talking about rent, we got to bring it into a month over month picture. So here I'm looking at month over month, but I've annualized it so that, in other words, if it happened every single month for 12 months, what would be that annual growth rate? So I can compare it to my annual growth rate goal. The Fed has 2%. And it went too far. And then how are we doing on inflation? So these are those same metrics, but here is the month over month change that's been annualized. And you can see it's coming down to target. This is the moment where we feel pretty good, right? Like this is where we know we're on the recovery side of this crazy thing we've gone through that is the pandemic. So we're like, okay, good, it's working, but you gotta remember those laugh graphs when you looked at the scale of the assets that the Fed had bought and were unwinding. You gotta remember when you think about that change in rent and how different it was from pre-pandemic, how uncertain that mean, how uncertain that makes us experts even, because there is a lot going on and there are a lot changing. So look at the CPI month over month, and you can see that had a really big month over month growth rate, despite having previously come down. Okay, so there's a lot, and the most recent, PCE there, you see that came up as well. Okay, so there's a lot that are going around and hopping around, and so the headlines, you'll continue to see a lot of uncertainty play out. We want to look ahead again. Okay. A lot of this is jump around. I want, and it's reported at a lag. These are prices of people buying things in the past. How can I look around the corner even more? And I'm, and all important to know whether or not we're out the other side, of this current economic shock, this pandemic, what happened over the course of the pandemic, the inflationary cycle, will inflation come down? Can the Fed stop putting upward pressure on interest rates and people can start borrowing again? And all these things, right, comes down to what's happening to inflation. A huge part of general inflation is shelter, right? So it matters a lot what this blue guy is doing. And this blue guy is month-over-month, annualized pace. So we look, what is it doing? How is it changing? But this is the shelter component of CPI. This is a third of the consumer basket. This is our market playing a huge role in how the Fed is thinking about macro policy. Okay, so Zillow can make this and put Zori out and then think, hey, is the asking rate market rent that we together are able to make when you put in the rental listings and we do the analysis, is that metric, the market rate asking rent, able to help us think about what's happening to the shelter component of general inflation, the shelter component of CPI, all those releases, not market rate asking rent, people who signed a lease again, renew that lease. Okay, that full market. The people that got their rentals on Craigslist, everything, the full thing, the shelter component of CPI is the everything, the stayers, the everything. You can see that's more slowly coming down. But Zori gives us that confidence that rental markets asking rate rent the pressure is still down, that general inflation, the shelter components should continue to come down, even though it had a big, a bit of an uptick this most recent reading. Our active, rental activity is giving confidence to policymakers that we are indeed steadily recovering. I know things feel, particularly soft right now because of a lot of that new supply, but in a macro picture, good news. Steady and slow, maintain the idea that uncertainty is real and you got to make resilient decisions. But we're on our way out of the woods. For you to explore any price pressure, information later on your own time, or new construction and building activity, we've got a lot of resources for you. You can see the QR code on this slide. We'll also be happy, to provide any of these resources or links again. Thank you so much for joining me and spending a little bit of time mastering your moment with some economics data. Thank you so much. See you next time.
Thanks, Skylar. Next, you will hear from Manny Garcia, Zillow's senior population scientist. Manny joined Zillow in October 2018 to work on Zillow's flagship Consumer Housing Trends Report and over 10 other renter and buyer surveys. Today, Manny will unveil exciting findings from the unreleased 2024 Consumer Housing Trends Report. With data collected from a nationally representative survey of over 21,000 renters, this report provides an invaluable snapshot of their preferences and behaviors. You are all the first to get these insights, as the full report won't be released until later this year. We will send all of you the full digital report upon its release. So today, you'll get a sneak peek as Manny shares some key insights from the report, focusing in on what home and neighborhood characteristics renters find most important. Manny, the floor is yours.
Hi, I'm Manny Garcia, and I'm going to be walking you through a preview of our findings from this year's Consumer Housing Trends Report on renters. So at Zillow, we strive to understand the needs and motivations of today's real estate consumers, and in this case, that's renters. In line with this goal, I'm excited to share with you a sneak preview of findings from our 2023 Consumer Housing Trends Report, which we will release in its entirety later this year. This report will give valuable insights into how renters shop, evaluate, and ultimately rent their home. During this presentation, I'll go through some of our findings from this year's research, and then I'll let you know what else to look forward to in the full report later this year. Our findings will help reveal how the rental market has shifted over time and what this means for you and your business. So before we dive in, let's talk a little bit about the methodology behind the report, how we collect the data, and what gets represented. For this year's report, our team conducted a nationally representative survey of more than 21,000 US renters. That's almost 3 times the sample of last year's survey. We defined renters as household decision makers ages 18 and up who rent their primary residence. The study was fielded between April and July of 2023. We recruit and weight our sample to accurately represent the true population of US renters. And whenever possible, we included survey questions from previous years, which allowed us to measure year-over-year trends in some key categories. So what are the key findings this year? So this is probably not a new one, but staying within budget is what renters consider essential almost entirely across the board. 94% said staying within their initial budget was essential. And cut by different types of renters, that was 96 for multifamily renters, 93 for single family renters, and 94 for renters in other types of homes. It outpaced other characteristics like their preferred number of bedrooms, floor plan, or number of bathrooms. And among renters who did not move in the last year, 72% said that part of the reason they stayed put is having a good deal on rental costs. And 2/3 said they couldn't afford to move somewhere else. This is a different set of questions, but it gets at a lot of the similar information. You see at the very top, 83% of renters said that the home being within their initial budget was very or extremely important. And that outpaced, again, bedrooms, bathrooms, floor plan. And at the bottom of this graph, you can see other shared amenities. A key takeaway here is that while those are lower than budget and always have been, that high importance is starting to see a rebound. 2023 marked the first year that we see high importance of common amenities rebound from its pandemic trough. We saw small incremental changes and increases in the importance of these common amenities like gyms and rooftop decks. And we saw that change start from 2018 through 2020, give pause during some of those pandemic lockdowns. And now we finally see, after some of the lowest numbers like we saw for gyms in 2022, now we see a big rebound. So between 1 in 5 or 1 in 4 recent renters consider each common amenity highly important. And for recent renters in multifamily buildings, that's more like half say that they consider at least one common amenity highly important. And that's higher than 41% of recent renters overall. We saw that similar 50% rate for renters who reported a household income of at least $100,000 a year. So among tenured renters, or those that didn't move, what kind of amenities did they report having in their rentals? A yard is the most common. At least half say they have some type of a yard, be it fenced or unfenced. 1 in 4 say they have some kind of fitness center, and other amenities like a business center, rooftop deck, or pet washing station are less common. So what do the renters that consider these common amenities highly important look like? They tend to be higher income. Their median income is between $60,000 and $65,000 a year, versus about $45,000 to $50,000 a year for those who didn't consider any common amenities as highly important. They trend younger with a median age of 28 versus 32. They're more likely to rent in a multifamily building of at least 50 units. They're more likely to use an iOS device, or at least have taken our survey on an iOS device, more likely to be employed full-time, and they're more likely to have larger households, be it a partner, a spouse, a roommate, or children. And they're more likely to rent larger homes. So that goes with the larger household, more bedrooms, more bathrooms, more square footage. But above all, renters care about budget. 41% is the total share of renters who said that common amenity was highly important, but 82% said the same about the high importance of staying within budget. So even among these more affluent renters, or even among renters who have more people in their household pitching in on rent, you still compete on price. So beyond budget and amenities, what else do renters value? Their pets. Last year's report found that renters increasingly have pets, and that trend persists. The share of recent renters with a pet has risen 11 points since 2018, and the share with a dog has grown 10 points to 40% in 2023. Renting with a pet has been the norm rather than the exception since about 2020. For tenured renters, pet-friendly amenities like a fenced yard and private outdoor space can help keep them in place. 71% of tenured renters with a pet reports having at least one common amenity, versus 56% for non-pet owning renters. These are things like a yard, a rooftop deck, and a pet washing station. Just over half of tenured renters with pets said that private outdoor space encouraged them to stay put, versus 40% for non-pet owning renters. We, to some extent, see that multifamily buildings and large property management companies might be dissuading pet owning renters. So while more than 60% of renters in single family and other types of homes have a pet, only 47% of renters in large multifamily buildings report having one. Pet owners are more likely to rent from someone they know personally or hear about through word of mouth. And they're more likely to rent from a private owner rather than a property management company. There's a whole host of possible reasons, like pet fees or restrictions, which may cause these types of rentals to underperform with the growing demographic of pet-owning renters. Another way of looking at this is that just over half of pet-owning renters say they knew their landlord or property manager personally or got them through a personal referral, versus 40% of renters without pets. So essentially, renters with pets are more likely to rent from someone they know, more likely to rent from a private owner, and less likely to rent compared to renters as a whole from a large multifamily building or from a professional management company. Whether it's rate restrictions, pet fees, bans, there's something about professional management companies and multifamily buildings that are underperforming among pet-owning renters. So what are some takeaways here? Well, one, we heard that budget is by far the most important factor for renters. It's the top thing they look for when doing their search, and it's the number one reason why they choose to stay put. So properties should carefully consider their pricing, their value, and potential incentives that could provide for renter loyalty. And while it trails in the importance of staying on budget, renter desire for common amenities like gyms and rooftop decks has rebounded. If you have common amenities, now is the time to show them off. We also know that renters increasingly have pets. Over half of renters reported having at least one pet in their household. These pets impact where they rent and whether they stay put. So make sure to accommodate these furry friends. Your strongest competition for pet-owning renters is smaller scale landlords, the more mom and pop, often single family or smaller scale operations. Those places might have more relaxed pet fees and more relaxed policies. So that's it for me on Renter Insights. As I've mentioned, this is a sampling of the data you'll find in this year's Zillow Consumer Housing Trends Report. We'll have much more like how renters pay their rent, what comprises their ideal home, what they shop for, and much more. You can see in the meantime, all of our research on zillow.com/research.
Thanks for those insights, Manny. As mentioned, we'll have the full report available for you later this year. So connect with your Zillow rep or follow us on Facebook or LinkedIn so you don't miss it. That's it for us today. It's our goal with this webinar series that our experts will help take some of the most recent, most relevant data on the market and distill it into news you can use, providing real information you can bring back to your businesses. We hope you found it valuable and that you'll join us again next quarter for our Q4 Insights Deep Dive in December. Thanks again for joining us. We'll see you soon.